generally when you have these periods of high inflation, the central bank just doesn't take that without a fight, right? So there's attempts, even in Weimar. We think of like the Weimar hyperinflation, but for example, if you bought gold on leverage, you got liquidated multiple times during that hyperinflation, because there were periods of time where the central bank would really fight back and harden the currency dramatically compared to gold. So what we're seeing now is that the major central banks, except for Japan, are doing their best to slow down money supply growth. In some places, it's even negative year over year. They're trying to slow down private sector bank lending. And it's been a kind of a mixed bag.
Gold and Bitcoin are at all-time highs while silver continues on a bullish trend. In today's episode, Lyn ALden will share her insights and experiences on the functionalities of money and will explain why she's so bullish on Bitcoin relative to gold and silver. Enjoy the video.
And so that history of modern banking kind of went from a bimetallic free banking type of arrangement towards increasing levels of central bank with a gold underlay, and then eventually just towards pure fiat banking that is largely based on network effects. So you have 160 different currency bubbles. They all tie together in varying ways into the dollar system. So that's the super currency that all connect into. And that's maintained generally through some degree of institutional separation and some degree of scarcity, which is that, even though the dollar loses all its value over time, we can always generally be high confident that a year from now, a dollar is still something akin to a dollar. And there's a specific set of processes that have to occur in order to create more dollars. Either banks have to lend it into existence, which means they have to manage their credit risk, or you have very large monetized fiscal deficits that rely partially on Congress deciding what they're going to spend on, and then partially on the central bank choosing how they're going to help facilitate that financing. There are certain periods of time, like World War II, where the Treasury just completely takes over the Fed, more or less, and basically says, "This is what you're going to do. This is what you're going to pay for. This is what your yields are going to be." But normally, there's some degree of institutional separation and some degree of sanctity around kind of the speed of money growth itself, and that's been enough to kind of keep the wheels on the cart. So you have something that is less scarce than gold, but faster and more convenient, and still scarce enough that people can use it as money. And like I said, people in, for example, Egypt or Argentina or you name it, they will have literally gray market dollars for people that, they say, well, I do hold some gold, but also I want to have some dollars too. And so you'll see kind of a proliferation in those markets. And that's the world we live in. And I think that we're now increasingly getting the consequences of that system, because the system is not inherently stable. It's only been metastable in the sense that it's been able to keep the wheels on the cart for 5 decades and counting. But some of those issues are building up more and more. So the public debts and the inability of so many different currencies to maintain a reasonable ledger. Because if we're in the United States or we're in parts of Europe, we've had a pretty continuous kind of low to moderate inflation for a long period of time, whereas in most people around the world, it's like if you're 50 years old, you've probably seen one hyperinflation. It's like something that when people think of hyperinflation, they think of Weimar, but the number of currencies that have outright failed in the past, in our lifetimes, let alone like our parents' lifetimes, is immense. Most developing market currencies have either hyperinflated at one point, sometimes multiple times, or they've gone through periods of double-digit, triple-digit inflation for a prolonged period of time. So it might as well be a hyperinflation. Like they've had to take some zeros off of the currency. It's something that it's not kept up. Like we still use basically banking transfer technology we used that was invented 50 years ago. Currencies themselves have had such a bad track record. And so we've gotten better at so many other things. We've gotten way better energy abundance. We've gotten way better technology. Like the fact that we're able to do this podcast now is remarkable, from different continents. We've gotten better at so many things, and money has, I would argue, been one of the slowest for lack of a better word, technologies or methods to really keep up with everything else.
In today's market news, silver price analysis, silver plunges to $24 after stubborn U.S. inflation report. Silver price falls vertically to $24 as sticky U.S. inflation allows the Fed to maintain a hawkish narrative. U.S. monthly headline and core inflation rose by 0.4% in February. On the other side, 10-year U.S. bond yields rally to 4.15% as hopes that Fed rate cut expectations would ease. Silver price plummets to $24.10 as the United States Bureau of Labor Statistics has reported that the Consumer Price Index remains hot in February. Annual core CPI that strips off volatile food and energy prices grew at a higher pace of 3.8% against the consensus of 3.7%, but lower than 3.9% in January. In the same period, headline inflation rose at a higher pace of 3.2% against expectations and the former reading of 3.1%. The monthly headline and core inflation grew by 0.4%. Quick recap of silver technical analysis. Silver price faces selling pressure after testing the horizontal resistance plotted from the December 22nd high at 24.60. The overall trend is still bullish. However, a price correction move is expected before a fresh upside move. Is this dip a once-in-a-lifetime opportunity? Drop a comment, like, subscribe, and check our links in description for some massive bonuses. Let's get back into the video.
Some degree of scarcity for, like, the dollar system essentially, and other kind of leading currencies, where it's the first time we've actually taken a step back in hardness in money. So we spent thousands of years kind of going up the hardness list of commodities towards things that are very hard to change the supply of. And this was the first time where speed was relevant. So we actually took a step back in terms of monies that proliferated around the world. And obviously in the past 15 years, now there's the prospect for things like Bitcoin that actually have finally given us digital settlement, that instead of sending an abstraction quickly that has to be reconciled later, we can actually send something that is by its own nature scarce, that's not relying on credit, and just send that to someone over the internet. So we might be entering a new era of money now, but that's kind of been the transition so far. Yeah, good question. I think when we think of the development of money, we can kind of think of two paths that were kind of happening in an overlapping way. So one was the underlying money itself, which until fairly recently was a commodity money. On one hand, as technology changed, as I said before, we would kind of start moving up to scarcer and scarcer types of commodities because other ones would become untenable in a more abundant world. And the other path was basically the path of banking, basically ways to make those commodity monies more divisible, more portable, more secure for transactions, and there is a specific pretty like a technology path there. So it's not just ideas; it's actually certain technologies enabled it to happen, like the invention of paper, the invention of bookbinding, the invention of the printing press. Basically, actual technologies that allowed us to abstract money in a more thorough way. And I kind of chronologue in the book because you start out, there's really old, like 2,000-year-old papyrus bills of exchange, for example. But they got more sophisticated over time, and money started kind of having a channel-like aspect to it. So, for example, during the medieval times, largely around the Islamic world, kind of the basically centered around the Silk Road and those regions, the Mediterranean, you would have a lot of the technology came from that time because that was when Europe had taken a step back in terms of their societal kind of organization, their prowess for a period of time. So the center of innovation was more in that Mediterranean Silk Road region, and they made advancements in paper that was originally invented by the Chinese, and then they made inventions of banking. So basically, you'd have these types of paper that you could deposit gold with a hawalidar, a money changer in one city, and have some sort of physical receipt that you could bring or send a messenger to another city that money changer has a connection to, and you could withdraw gold in another city. So you basically are making gold more portable through abstraction. And one way to think of this is it's basically early encryption,
Mm,
because obviously they have to make sure that someone can't just like see one of those notes one time and then go counterfeit them and trick another money changer into giving them gold that another money changer actually didn't authorize, because then they're going to have an argument about who has to pay it. So one will think that another person owes him, and the other person's like, I didn't write that. So they had to have ways to verify that they actually authorized this transfer and that they are now taking on this debt to another money changer as part of this abstraction process. And then with the inventing of the printing press, that was one of the factors, along with just the Renaissance more broadly, that allowed Europe to kind of become the center of monetary development for a period of time. And the printing press allowed for, more complex paper arrangements, and things like banknotes, where instead of just, a channel based, like, one city to one city, you could have a large recognized institution that would issue banknotes that are just bare assets that are redeemable for things like gold. And so basically, as the world became more networked together, uh, as information moved quicker, thanks to things like the printing press, or thanks to better ships and, just better technology overall, they started to become more interconnected, more complex banking systems. And then, as I argue in the book, the telegraph kind of put that in overdrive, because that was the first time where humans could send large amounts of information faster than material movement. Prior to
mm,
then, other than very limited bandwidth ways like fire signals of the night or something, there was very few ways to send money faster than just a person on a ship or a horse actually sending information. So matter and information used to move at the same speed, but when we decoupled those, that gave us a big challenge for money. And so you basically you had to increasingly abstract money, in order to keep up in this kind of telecommunication enhanced world. But what that did was it opened up massive arbitrage for the banks and the governments to abuse that arbitrage, and that gap between transactions and settlements, and eventually basically take control of it.
What do you think of today's show? Will Bitcoin outperform gold and silver in 2024? Post in the comments section your price prediction for Bitcoin and tell us if you're bullish on gold and silver. Subscribe if you have not yet done so, and watch this video right here because you'll love it. I see you on the other side.